The inflation hedge, why gold, Bitcoin, and real estate aren't what you think. Every time inflation spikes, the same conversation happens. People panic. They look for something to protect their money, and they reach for the same three assets: gold, Bitcoin, and real estate. These are the canonical inflation hedges, the stores of value, the things that hold their worth when paper currency doesn't. The problem is that the relationship between these assets and inflation is far more complicated than the narrative suggests, and acting on the simplified version of that narrative can be far more damaging than the inflation it was meant to protect against. Gold, the oldest hedge with the most complicated track record. Gold has been used as a store of value for thousands of years. The narrative is simple. When governments print money, currency loses value, and gold, scarce, physical, nobody's liability, holds its worth. The historical data is more nuanced. Over very long periods, gold has roughly maintained its purchasing power, but over specific periods, sometimes decades, it has failed dramatically as an inflation hedge. In the 1980s, gold lost 60% of its value in real terms while inflation remained elevated. From 1980 to 2000, it underperformed almost every other major asset class. Gold works as a hedge in specific scenarios, particularly when inflation is accompanied by financial system stress, currency crises, or geopolitical instability. In normal inflationary environments driven by strong demand, equities typically outperform gold significantly. The problem isn't that gold is useless, it's that people buy it at the wrong time, after it's already run up, and hold too much of it, displacing assets with better long-term expected returns. Bitcoin, digital gold or speculative asset. Bitcoin was explicitly designed as a hedge against currency debasement. Fixed supply, decentralized, no government can print more of it. The narrative is compelling. The track record, given Bitcoin's short history, is mixed. In 2022, when U.S. inflation reached 40-year highs, Bitcoin fell over 65%. Not exactly the inflation hedge it was supposed to be. The correlation between Bitcoin and risk assets, particularly technology stocks, has been far higher than its correlation with inflation. In practice, Bitcoin has behaved more like a high-volatility speculative asset than a currency hedge. This doesn't mean Bitcoin has no role in a portfolio. A small allocation, 1% to 5%, in an asset with potential asymmetric upside and low correlation to traditional assets can improve portfolio efficiency. But sizing it as a primary inflation hedge is misunderstanding what it is and how it behaves. Real estate, the hedge that actually works, with conditions. Real estate is the inflation hedge with the strongest empirical support. Property values and rental income tend to rise with inflation over time because the replacement cost of buildings rises with material and labor costs, and because rental income can be adjusted to reflect higher living costs. The problem is the conditions required to capture this hedge effectively. Direct property investment requires large capital, concentration in a single asset, illiquidity, and active management. A single property in a single city is not a diversified inflation hedge. It's a concentrated bet on one local market. REITs, real estate investment trusts, offer a more liquid, diversified alternative, but REITs are publicly traded and correlate significantly with equity markets in the short term, which means they don't always provide the inflation protection when you need it most in equity market downturns. What actually works? The most reliable inflation hedge is a diversified portfolio of equities in businesses that can pass rising costs to their customers. When inflation rises, companies raise prices, revenue rises. Earnings often keep pace with or exceed inflation. Over the long run, equities have been the best inflation hedge in history, better than gold, better than real estate, better than commodities, because they represent ownership of real productive assets in a growing economy. The second most reliable hedge is short-duration bonds or Treasury inflation-protected securities, TIPS, which adjust their principal value with inflation and pay a real yield above it. These don't generate the returns of equities, but they protect purchasing power with much lower volatility. The answer to inflation is not a single magical asset. It's a diversified portfolio built for the long term, tilted toward real assets, and away from fixed income instruments that don't adjust for inflation. The assets people reach for in a panic, gold at all-time highs, Bitcoin after a 200% run, are often the worst possible time to buy them. The assets that actually protect against inflation over time are the boring ones people were already supposed to be holding.